Hello, everyone, and welcome. We have a great show for you today. My name is Susan Johnson. I am with NFP. I'm a financial coach. I have been in the industry for 18 years. Nick?
Good to be with you, Susan. I'm excited for our topic today. I'm out of our Nick Walker. I'm a wealth advisor. I work with financial education, group meetings, webinars like this. I've been in the industry for not quite that long, about 11 years. Been with NFP for 3, and I'm a certified financial planner. So I'm excited to talk about tax efficiency and retirement with you today.
Awesome. So let's get started. Okay, waiting for my PowerPoint here. There we go.
There we
So,
go.
yes, as Nick said, tax efficient retirement strategies is our topic for today. And the nice thing about it, it's going to lead us to the goal, which is minimizing tax burdens and maximizing our our savings as much as we can. So, the agenda for today will be understanding the tax efficient strategies. We will get into RMDs, also known as required minimum distribution. Many of you have heard of this. Nick will definitely go through and shed some light on the confusing topic of Roth conversions. We'll then stop in and talk about our HSA accounts, health saving accounts. And then Nick is going to definitely elaborate on some tax strategies for tax loss harvesting. So, when we look at understanding tax efficient retirement strategies, they are essential for minimizing tax liabilities. And the important thing about them, I think there's three. And number one is financial health maintenance. And we are all so definitely taking charge of our own financial health by, going to doctor's appointments and keeping up on all the things we have to do with that, exercising, dieting, all sorts of things. So why wouldn't we do the same for our financial health? So part of this discussion, the tax efficiency is just vital for maintaining that health of our financial wellness. And then obviously that will lead to enhancing overall income, which is definitely the main goal in retirement, strategically planning on how we can just keep our game plan going for the longevity of our savings and get to where we want to be. Now, some of the common strategies are tax advantage accounts. Now, many of you are aware of utilizing these accounts through either IRAs that you may have had over the years, and most importantly and most common are 401k plans that you have with current employers. Maybe you have a 403b or some other type of retirement savings account, but all these are going to maximize that retirement savings, thus minimizing your tax liability towards retirement. We'll also discuss, careful withdrawal management. And when I mention withdrawal management, what I mean by that is that think about it when, maybe you have family members that are in retirement now, or perhaps you're approaching retirement. A lot of times you think, I'm going to take money out at this point in time, and just randomly picking it, when in fact, that should be a coordinated game plan, part of your effort, part of your strategy to perhaps coincide with your partner, your spouse, however. So we'll shed some light on that. And then the investment tax implications, looking at all the different retirement accounts as well as your non-retirement accounts and seeing what kind of strategy they have and being mindful of that. So tax implications on the retirement account, we just, kind of went over the 401k and the IRA. And the thing that, you'd like to definitely check up upon is that the tax implications are different. So for example, in an IRA, you can, when you take money out over 59 and a half and at withdrawal age, there is you can take out 10%. Sometimes you can they will withhold 10%. Maybe they won't withhold anything. But when you withdraw money from a 401k, there will be a mandatory 20% withholding. So you want to check your various accounts and make sure you're aware with any kind of tax implication. Taxation on the withdrawals, we just went through that. And then again, falls into our effective tax planning and just making sure that your goal, which is significant savings, is going to take you down the road for that. Nick, any thoughts on any of these topics?
Yeah, no, I like that you I like that you highlighted the differences. It's not just the difference of how the money is taxed when you take money out of these various different accounts. You know, we typically talk about traditional IRA, traditional 401k, and I know I'm guilty of it. I'll say, hey, as far as from a tax perspective, it's effectively the same. When it comes out, in most cases, it's going to be taxed as ordinary income. There are some minor differences. You highlighted one, which is that when you withdraw from a 401k, they're going to mandatorily withhold 20% for federal tax. That may be fine for you. I know that I have countless conversations with folks that after they've retired and they're looking at, hey, I know that come tax time, my tax liability, I'm in the 12% bracket. I'm not anywhere close to the 22% tax bracket. Why would I withhold 20% for federal taxes? Well, that's someone that might want to consider rolling into an IRA so that they have more flexibility on how much they withhold. And when I think about just tax implications in retirement, when obviously, if you're on this call, it means that you're likely still working. And we're going to be focusing on tax strategies in retirement, but everything that we talk about here is something that you can apply now with a little bit of just looking forward to, okay, if I make these changes now, if I adjust to contributing to Roth now, if I start contributing to my HSA now, some of the things that Susan and Nick have been talking about that are going to impact my retirement and my tax load in retirement, I can help position myself better by making decisions now. You know, in your working years, you spend most of your career, it's just about maximizing your return. You're trying to build up the biggest nest egg possible, or at least the nest egg you need to meet your retirement goal. And that varies widely for all of us, right? Like a light switch, after you retire, it's no longer about accumulating. It's no longer about, you know, getting as much as you can out of your accounts as far as return. It's about holding on to as much of it as we can. And asset location, asset mix, those are important. But making efficient decisions as far as your tax decisions is all of a sudden it goes from not being as important to, wow, this is something that I'm thinking about. I'm either thinking about this every single year, or I'm working with a financial advisor every year to figure out what is the best strategy for me to withdraw from my accounts.
Yeah, and a lot of times, Nick, people are working with their parents on this now that are in retirement. So
that's a great
really helpful information.
That's how most of us get our first look into it. And we've got a couple, notes going on. If you haven't noticed, if you have any questions, feel free to put those in the chat and we will get to them as we go, or we'll save them for the end.
Right. And so with that, I'm going to now throw it back into Nick's court, and he's going to go over some interesting information regarding the U.S. tax system. I think most people find this very confusing at times because of the way the levels are. So Nick, shed some light on this for us.
Thank you, Susan. So the reason why I wanted to go over this really at the top before we get into some of these more specific tax strategies and topics is that everything that we talk about from this point forward, we're talking about taxes. We need to talk about our current tax code. Right here, this is our 2025 federal income tax brackets. Now, one of the most frequent kind of misunderstandings that I run into as far as the U.S. tax code is not understanding that it is a progressive system, meaning that if let's take married filing jointly couple. Let's say that they make, $250,000 in a year. You look at that chart over on the right and you see, oh, that puts me in the 24% tax bracket. I talk to countless people that think, oh, do I really, I really want to avoid getting into a new tax bracket if I can help it, because that's a huge increase in my taxes. It's true that there are strategies where we certainly want to be mindful of where we are and what bracket we're in. We don't want to unnecessarily push ourselves into a new tax bracket, but this is something where, up to, for married filing jointly, in that example, they're going to be paying up to $23,850 in earned income or taxable income. They're going to pay 10%. and so on and so forth. And we actually have an example on the next slide that I'll go through.
Okay, great.
So now this does not take into account the standard deduction. So let's just say for a single filer, standard deduction for 2025 is $15,000. Let's just say they had taxable income of $65,000. You take off that standard deduction, okay, we're left with $50,000 worth of taxable income. For a person with that level of taxable income, single filer, the first $11,925 are going to be taxed at 10%, lowest tax rate that we have, right? Then the next $36,550 is going to be taxed at that 12% bracket. And then in this instance, that person at $50,000, they're just barely dipping into the 22% tax bracket. So, I like this example, especially with thinking about, well, with a 401k, for instance, if you make deductible contributions to a 401k, if you contribute at least $1,525 to a traditional 401k where you get to deduct those contributions, you could avoid paying that higher tax rate at the 22%. And jumping from the 12% bracket to the 22% bracket, it's the largest increase in our tax code. So you're going to hear me talk a lot about that here in a minute when we talk about, especially around Roth conversions. But understanding where you fit. So in retirement, many folks, I'd say the majority, probably fall into the bucket of, hey, Nick, I'm about to retire. I'm going to get X amount of dollars in Social Security. And then I've got my 401k. It's all pre-tax money. And then they may have an emergency fund. Now, there's plenty of people on this call that likely have, maybe a more complicated array of assets, but I probably do over 1,000 of those financial planning conversations in a year. Many people fall into that, kind of that category that I just described. For them, you're going to be looking at, okay, Social Security plus my expected taxable withdrawals, where does that put me in my tax as far as those tax brackets? And being mindful of, hey, if I can avoid unnecessarily putting myself into a new tax bracket, that's something that I want to be mindful of. I'm going to give one example before we move on, Susan. So, a common question that I'll get, let's say this person, let's change this. Let's say they've got $50,000 worth of taxable income, but it's in retirement. So it's Social Security that they're receiving, right? Social Security plus, let's say they have a pension. This is a single filer. They've got $50,000 worth of taxable income. Well, if you go back to the previous page, Susan, just briefly. So let's say that they have $200,000 in their 401k. I got this question last week saying, hey, should I keep my money in the 401k? Should I roll it into an IRA, or why don't I just go ahead and cash this out, put it in my bank, and I can invest it there. I'll just go ahead and pay the taxes. The reason why I'm going to tell that person in 99 out of 100 situations likely is I don't want to do that, because for that person, okay, if they've got $50,000 worth of taxable income, if I take an additional $200,000 of taxable income, all of a sudden I'm pushing that person. They're going through the 22% bracket. They're going through the 24% bracket. They're dipping into the 32% bracket. And that person has no business paying 24, 32% tax on their income, because I'm assuming that with $50,000 worth of income, $200,000 in that pre-tax 401k, if they make regular, a healthy withdrawal rate year to year through retirement, they're more likely going to be staying in that 22% bracket. As long as we're not taking, huge chunk withdrawals from the plan, just to illustrate. That's a common thing that comes up.
Okay, great. Well, a lot of information, but take it in chunks, everyone, because this is a very broad topic, and so we're giving you little pieces. So now, what are RMDs? As we mentioned, they are required minimum distributions, and how do they actually work? So basically, the IRS has a threshold that maybe you've heard that at a certain age, you have to start withdrawing money from your account. Now, many people think it's age 59 and a half. However, 59 and a half is for, that just says you can take money out of your retirement account, 401k, 403b. You can take money out because you're at 59 and a half without that 10% penalty. That's all it means, okay? But the magic age used to be 70 and a half. However, over the last couple of years, the IRS moved it up to age 73, and that's what we have on our screen now. So at age 73, you must begin taking your RMD, your required minimum distribution. If you were born 1960 or later, the age is 75, okay? So what happens is that whatever financial institution you are with, you'll start getting notices roughly, maybe September, October, saying, get ready, you'll need to take this. So when I look here on my screen and it shows the calculations of the RMDs, well, how are they actually calculated? What happens is the IRS has, if you feel so inclined to do so, you can go to the IRS website and look for their little chart, and it will tell you a factor. And you look at your age and you will get a factor. If you take that factor and you divide it by your previous December 31st balance, that will tell you what your RMD, your required minimum distribution, is. One way. If you don't want to go through all that problem, your financial institution will generally let you know, your accountant would let you know. And if you feel like, I don't want to wait for that, I just want a quick way to do it, you could take that previous December 31st balance, multiply it by 4%, and you're going to get a darn close estimation in the range a little above a couple $100 above or below whatever your amount is. So you got 3 ways to get that calculation. But generally, you will be notified of what that is. And then the bottom, which I think here, it says the importance for retirement planning. Most people really forget about this, and it's always the last minute. And that's one thing you don't want to do because, December, we have holidays, we have all sorts of things. People are traveling. A lot of people take vacation. And so when you're calling your financial institution to say, oh my God, it's 3 days before the end of the year to take it, you just don't want to wait that long. So again, a little, put it part of the planning process, talk to it with your financial advisor, and cannot stress enough about the timeliness of taking it, because the IRS doesn't look too kindly on the fact that those people who do not take it timely. So here's what happens. Let's just say, things happen and you're busy, you're traveling, you're out of the country, who knows, whatever it is, and you realize, oh my goodness, I didn't take it for the year. What you would do is you would make the payment ASAP, as soon as possible. The IRS looks at the fact that you took it in a timely manner and a good faith effort. And there is a form, I think it's like a form 5329. You can go online, look that up, and you put your little statement as to why you didn't take it on time. Generally, they'll look favorable upon it. However, it's at their discretion. If you were someone who said, you know what, I don't feel like doing this, I got other things to do, and you take that kind of attitude, well, that's where it's not going to be so nice, because they could impose, and they will impose, up to 25% penalty on the amount that you should have taken, and it will go every year until you take it. So, Nick, have you come across that in your travels about anyone, having problems on that end?
I don't run into problems around RMDs as often, just because, financial institutions are held to a pretty high standard of making sure that they communicate that amount to you. I find when I'm thinking about, applying some of the rules that you mentioned to estimate my required minimum distribution, I'm more so thinking about, okay, I'm talking to someone that just retired, they're 65, and we're making some growth estimates on their pre-tax money. We're trying to get an idea of what those required minimum distributions might look like down the road.
Yeah.
If you're already RMD age, then you're definitely going to want to go with what your financial institution has calculated for you. I always like, if you've got someone that's holding your money and they're giving you a required minimum distribution amount, I mean, yes, check their work, but ultimately they are being held to a pretty high standard to make sure that you're taking out the correct amount of money.
Absolutely.
And that actually gets to, we had one question come through saying, can we choose our own required minimum distribution amount? And we can't. So this is something that is dictated by the IRS. So by those life expectancy tables that Susan was referencing. And, if you look up those life expectancy tables, one thing that you're going to notice is that in age 73, your required minimum distribution is a little less than 4% that they require you to take out. And the whole reason why required minimum distributions exist on those pre-tax accounts is because they're saying, hey, hey, Johnny, I'm glad you enjoyed not paying taxes on this money for 10, 20, maybe 30 years. We want you to go ahead and start taking this money out so we can tax you on it. And the percentage that they require you to take out each year actually increases every year as you get older.
Yeah.
So even though it starts at less than 4%, you're going to find out year over year, it's going to start to be a larger and a larger chunk. And that's part of the reason why we're having this, covering this topic today is how can you make decisions with your total assets to be mindful of that?
One thing I will say about choosing your own RMD, yes, correct in what Nick said, you can't choose it. So the thing you could do is that once you get that calculation, let's say for argument's sake, you had to take $5,000 out, but you wanted to take 8 or 10. You could do that as long as it's above and beyond the amount, but it could never be lower. So just, we'll bring that up. Right. All right. So let's see what we have next on our agenda, which is, here we go, Nick. You have some really good ideas for this.
Yep. So, and I want to throw in just two little fun facts is probably giving a little bit too much credit. They're not all that fun, but other things to be mindful of as far as RMDs. So you are going to have the first year that you take out a required minimum distribution, you are allowed to delay it until April 1st of the following year.
Good point.
So if you retire in 2025, you're allowed to delay it until April 1st of 2026. Now, why would someone do that? I would say the number one reason why someone it comes down to, would you like to have more taxable income next year versus this year? So if you're talking to someone that usually we don't retire, spot on the first of the year or right at the end of the year, right? It ends up being somewhere in the middle. But let's say we're talking about someone that worked 11 months out of the year. That means that they have we're going to go ahead and assume they have a lot of taxable income for this year. But the fact that they retired in November, they are required to have it. And if they are, age 73, if they are RMD age in the year that they retire and they've worked almost a full year, they may not want to take a distribution. They certainly are likely in a position where they don't need that additional taxable income. It is very possible that they would be better off delaying their required minimum distribution to spring of 2026. Now, you're going to have to take out your 2025 RMD. They're going to calculate a 2026 RMD still. So you're going to have more that you have to take out in the tax year 2026. But someone that's working for most of the year, maybe, often those later years or some of your higher earning years, that is really what that's meant to help. Now, it doesn't always work out that way, but it's something to be mindful of.
Good point, Nick. Very good point for pointing out, because I think a lot of people don't realize when they delay it like that, now they're responsible for 2 in 1 year, and they're not so happy about it. So, yeah. Listen, before we go on to the Roth, which is going to be a great topic, let's take a poll question and see what the audience has to say about one of our poll questions. So, I guess what we could do is continue as the poll question shows up. How's that?
Here we go. Okay. So, all right. So, well, yeah. So getting into, we'll jump in the Roth conversions here. So just before we get into talking about it, we're going to be talking about moving money from traditional pre-tax assets into Roth after-tax assets. So just based off of that, do you think that Roth conversions can impact your Medicare premiums? And you've got a few answers there. We'll give it a second for everyone to chime in with their answer.
Okay, I'll make it.
Yeah, this is something we're going to talk more about this, Susan, but while we're waiting for the answers to come in,
Okay.
um, there is, Roth conversions are, certainly something that maybe one of the more complicated topics that we're going to talk about today. And there is a lot of things that go into it that people don't think about. Sometimes you hear about, hey, are there any um, drawbacks to me doing this, little things that I might be missing? I'm seeing some answers come in. I'm going to go ahead and tell you that the answer to this is, well, C is a great answer. I'm not sure. I need more information, but the answer is yes. Roth conversions can impact your Medicare premiums, and we'll talk more about that here in a minute. All right, Susan, let's go ahead and jump to the next.
You know what? Before
Yeah.
you go on, I want to answer a question. And someone put in, and I think two people put this in. It says, "I have a 403b. Can we withdraw contributions without penalty? If yes, how much of a contribution can we withdraw?" Now, I just want to elaborate, and then I'll pass it over to you, Nick. In the beginning, I mentioned that the age of RMD, required minimum distribution, was 73, but I also mentioned 59 and a half. So let's say you're working and you're 60, 61, or whatever the age is, but you're over 59 and a half. You could, in essence, withdraw money from your 401k, 403b retirement account. However, you will not pay a penalty. Why? Because you are over age 59 and a half, but you'll still be responsible for the taxes if in fact it is a pre-tax account. Nick will talk about the Roth, but I just wanted to answer this question because I did see it come through. So no penalty if you're over age 59 and a half. I hope that answers your question.
All right, let's get in the Roth conversion. So, yes, great. So where I want to start with, we're talking about all these different types of accounts. You think about, you have a lot of different options as far as savings. We're going to talk about HSAs more later, but your employer plan, your default investment option and contribution option for your 401k or 403b is going to be pre-tax contributions, which is where, and we had a question earlier about the difference between traditional versus Roth. With pre-tax traditional retirement accounts, the contributions you make, you do not pay taxes on it now, so it's deductible from your taxable income. But then however many years in between then and when you actually start taking the money out, it's growing tax deferred. And when you take those distributions out, it's going to be, in most cases, it's going to be taxed as ordinary income. Roth is the exact opposite. If you make a Roth contribution, you put in $2,000 into a Roth 401k, ultimately that's not going to make any difference to your taxes for tax year 2025. You're paying the taxes. You don't have the money in your account. It's not income that's in your account. You saved it. But the benefit, the trade-off, is that that's going to grow for however many years, and it's going to grow tax-free. Whatever that dollar amount, that $2,000, whatever that grows into, all of that is coming out tax-free as long as we've met a few conditions that we're going to talk more about here in a minute. So that's really what we're talking about here, is that for a Roth, who is the right person for Roth money? I'm going to talk more about how this impacts you in retirement here in a second. But as a general rule, you hear a lot of positive things about Roth. I mean, when people like Roth, they kind of talk about it like it's the best thing since sliced bread, right? So the idea is it's about when you want to pay taxes, right? So do I want to pay taxes now? Do I want to pay taxes later? The younger I am and the less money I make, the more interested, the more likely I am to make Roth contributions. There are exceptions to that. It's going to depend from person to person. And then on the opposite end, the older I am, the closer to retirement I am, the more money I'm making, and usually those two things go hand in hand, the more likely I'm going to want to make pre-tax contributions. And just a quick little example for both. You're talking to someone in their 20s, probably not their highest earning years, right? That person, it's not an exaggeration to say they have a 40-year investment horizon until they're actually going to be taking this money out. Well, if I pay taxes on that money now, it's going to go up multiples because of compounding interest and turn into a very large amount of money if invested appropriately, likely in retirement. On the pre-tax side, okay, if I'm talking to someone that's within 10 years of retirement, we've got a lot better idea of what their tax load might look like in retirement. So we can say, okay, if it looks like your tax bracket is going to change, it's going to go down. You're in the 22% tax bracket. You're about to be in the 12% tax bracket. Well, we're probably going to decide to do pre-tax contributions. I'd rather not pay the taxes now. I'll pay the taxes later when I'm paying 10% less as far as my bracket. So that's really what we're talking about here as far as the value proposition of Roth versus traditional. Now, you also get, so we talked about those tax-free withdrawals. No required minimum distributions since you've already paid taxes on it. You do not have RMDs from a Roth IRA that you own. It's different for inherited Roth IRAs. And then the retirement planning advantage. So the idea is by the time I get to retirement, I'd love to, we talk a lot about wanting diversification as far as your investments. If I can have it, and if I start early enough, I can. I'd like to have diversity in my assets on how they're going to be withdrawn. If I have a Roth bucket, a pre-tax bucket, and a non-retirement bucket taxable that's handled by long-term capital gains rates, that gives me a lot of flexibility to help someone in retirement every year to figure out what's the right recipe to withdraw from these various accounts so that we not just pay the least amount of tax now, but level out our taxes over time and avoid any spikes in our taxable income.
Well, Nick, that's a really important point. And I get a lot of those questions, and primarily from a lot of, I'll call them young people, younger people. Maybe it's their first time job, or they've been, in the not too long and they're contributing and they don't know which one to contribute to. And often I'll say, well, why not do a little of both? So if they tell me I'm contributing 6%, maybe you do 3% in the Roth and 3% in the pre-tax, because what that's going to ultimately do down the road is, like you said, create those two different buckets so that when they are over 59 and a half, they could say, if I take some from my pre-tax, I'll have to pay the taxes because it went in prior pre-tax, but my Roth, I could do the kitchen over now at retirement. We could take a trip. We could buy a second home, and that money is tax-free. So the buckets are very important in the planning.
I think, and I want to elaborate on that. That's a really good point. And I would say for younger folks, the two main situations I run into where we have the conversation about, Roth might not be the right answer for all of your contributions would be, if you're juggling, oftentimes you're talking to someone in their 20s and 30s, pretty good chance that they've got I know it's hard in this environment, but saving for retirement and saving for a house is very difficult. One way to make it a little bit easier on yourself is if you're making pre-tax contributions, is that going to be as valuable for you for retirement? Maybe not, but it does put more money in your pocket come tax time that you could use for, say, saving for a home goal, kind of juggling different financial priorities. Or I may have someone, you think about those tax brackets we were talking about earlier. They may, if they're kind of dipping into a higher tax bracket, they may come to the conclusion that, I'm going to save enough in pre-tax contributions to avoid that higher tax bracket. But then beyond that, I'm comfortable with Roth conversions just based on the limits that they put on themselves. So it is something that, and this is a good time to say, we're talking about these in general terms. These are all things that we talk about on a one-on-one basis, and you have access to advisors like Susan and myself to talk through these topics about your specific planning needs.
Yeah. And what's important too is that, interestingly enough, when you're looking at retirement planning, investing, it's just not a one size fits all, because so many times people think, oh, so-and-so told me about this and that. And that's why Nick really made that point to say that it's a unique experience, because what one person's case and goals are totally different from somebody else. So it doesn't mean that the person that gave you that information is wrong. It's just that you might not know the whole picture behind why they did that, and it may not apply to you. So good point, Nick. And let's see what we have on our next slide as far as the Roth.
Right. So let's talk about how does a Roth conversion work? So there's a lot of different, and I've seen some questions on here that I'm going to elaborate more on at the end of our time, because they go in a little bit different direction when it comes to like backdoor. You may have heard of backdoor Roth contributions, kind of a different reason to use a conversion than what we're really covering here. But at the end of the day, what a Roth conversion is we're moving money. Let's say we've got a traditional IRA of $10,000. We want to convert that into a Roth IRA. So we want to take that $10,000, we want to put it in a Roth IRA. Well, we haven't earned any additional income, and yet we're going to owe income tax on that $10,000 that we convert over. So it's figuring out, is that something I can afford to do? Is that actually truly in my best interest to do that? Right. Ultimately, in most cases, except for some cases with backdoor Roth contributions, the Roth conversions we're talking about here is basically voluntarily paying taxes so that we can move money from one place to another so that it's now in a vehicle that can grow tax free. And there are a few different scenarios where that I run into where that makes the most sense. Ultimately, we're trying to figure out, okay, by doing this, by eating this cost now, is that going to benefit me in the long run? Is that going to benefit my beneficiaries in the long run? When we talk about Roth conversions, legacy planning comes into it as well. Susan, let's go to the next slide. Thank you. So the first thing we need to do, not the last time I'll say this here, is that we need to understand what is your current tax bracket. Okay. So ultimately, just again, thinking about this here, let's say that you are, I'm going to pick on that, 10 years within retirement crowd. If you're in the last 10 years of work, there's a good chance that those are some of your higher earning years, right? And if that's the case, well, doing a Roth conversion at that point, even though you're younger than you will be 10 years from now, after you retire, let's say, we can pretty safely assume in most cases your taxable income is going to be much higher than what it's going to be 10 years later after you retire. So the idea is, okay, well, if I'm in the 32% tax bracket right now, and I'm going to be, I might be in the 22% tax bracket, I might even be in the 12% tax bracket, depending on what level of spending you have in retirement. That's probably not the right time to do a Roth conversion. You're looking at your tax bracket and you're saying, okay, well, based on my future income expectations, I think I'm going to be in a lower tax bracket later. Maybe it would be better for me to do Roth conversions later on down the line. Let's keep going with that example. So let's say that, hey, right now is not the right time. 10 years later, they retire. That person at age 65. That person this is a very commonly used window for Roth conversions. Mm-hmm. Now, I'd say the majority of people don't necessarily need to do a Roth conversion, but when Roth conversions are beneficial, this is a primary time to take advantage of, in between 65 and when you have required minimum distributions. Because once you have required minimum distributions on your pre-tax money, the way Roth conversions work is that you have to satisfy your required minimum distribution, and then any amount that you convert is on top of that. You can't convert your required minimum distributions. So, who would fit into that category as far as that working for someone? If you're looking at someone that referencing back to required minimum distributions, you're sitting there at age 65, your income's a lot lower, and you're looking at, based on my pre-tax money, if this continues to grow in between now and when I have required minimum distributions, my RMDs are going to be greater than the amount of money that I actually even want to spend from year to year. I'm being forced into a higher tax bracket that I necessarily even want to be in or need to be in. That's someone that should talk to a professional like our team to say, okay, well, is there a value to us doing incremental conversions over that gap between age 65 to age 73 or age 75, depending on the age of the individual, to basically level out our tax burden. That person might say, hey, I've got $2 million in a pre-tax account, and I've got $500,000 in a non-retirement account. Well, If you were just trying to lower your taxable income immediately, what any advisor would tell you to do is, oh, we'll just take from that non-retirement account. That's not taxed as ordinary income. It's just going to be taxed based on long-term capital gains rates if you've held those securities for more than a year. Well, the impact of that is that you're not taking advantage of those lower tax brackets, and you're letting your pre-tax money grow to the point where those required minimum distributions may be kind of larger than we would like them to be. Someone in that position should be likely considering, hey, I should be focusing more on paying my bills during this time with pre-tax money. That'll lower my required minimum distributions. And they may even take it a step further to say, I definitely want to take advantage of, thinking back to the 12% tax bracket. With my clients that I'm taking them into retirement, we always talk about year to year, we want to take advantage of the lower tax brackets, and that's the 10 and the 12% bracket. And then there's a big jump, but it's going to vary from person to person. That's the way that, that's just one example of where this might come in.
Okay.
Now, Susan, I'm going to just touch on this real quick. The impact of financial aid. I know we do have, we covered that poll. We mentioned Medicare premiums. Your taxable income can push you, it's based on IRMA brackets, it can push you into a higher level of taxable income where your Medicare premiums will actually be increased. Most things surrounding financial aid have to do with how much taxable income that you have in a given year. If you're talking to someone about what the benefits of Roth conversions are for you, you should be talking about what impacts are that going to have to my premiums and any other financial aid that you might qualify for.
Okay. Sounds good. Great. So I think before we go to our next topic, let's look at a poll and see what we have and answer some, let's see what the audience thinks about this. So how many years must a Roth IRA be open to qualify for a tax-free withdrawal after age 59 and a half? Is it A, 5 years, B, 2 years, or C, 7 years? Let's see what we got.
All right. So as far as the answer here, we talked about, we've mentioned that, hey, with Roth money, with pre-tax money, if you wait until 59 and a half, you can take out, those are called qualified distributions. For a Roth IRA, there's a second piece to it. The account has to have been open for at least 5 years. So if you haven't had a Roth account established for at least 5 years, this is something to be mindful of. A common mistake I run into with this is, say people have money in a Roth 401k. They're planning on rolling it into a Roth IRA after they retire. If they've never had a Roth IRA, and they roll it over into a Roth IRA, that starts the clock at that point. So something to look at might be, hey, I'm not really looking at making meaningful contributions into that Roth IRA, but opening one up, making a small contribution just so you kind of start that clock. If you're planning on rolling from your Roth 401k into a Roth IRA, would you strongly consider that? But it is 5 years.
Perfect. Okay, so another favorite topic that can be confusing at times. So we'll delve right into the HSA, the Health Savings Account. So the interesting thing about this account is that it's a tax advantage account that you can use to save money to pay for qualified medical expenses, because the contributions that you put in, the withdrawals that you take, and any kind of investment growth, they're all tax free. So this way your money can carry over year to year in this HSA plan. Now, it is associated with, it's called the HDHP, a high deductible health care plan. So if you do not have that, then unfortunately this HSA, the savings account, the tax-free with all its benefits, would not be appropriate, it would not be available to you. So it does go in conjunction with the high deductible health care plan. So the tax advantages, as we mentioned, are triple. And first off is when you're contributing to this plan, any post-tax, any post-month tax money that you contributed is tax deductible. Therefore, it's going to reduce your taxable income. And, well, I'm sorry, the post is going to be tax deductible, but any pre-tax money that you put in via your through your payroll will reduce your taxable income. On the spending aspect of it, when you take out money to pay for qualified medical expenses, it's going to be free from your taxes, which is definitely nice. It's definitely convenient. And then the investing, you can choose to have a portion of it invested or all of it, however you wanted to do that. Now, the role of the HS in retirement is to allow you to use these funds specifically for healthcare expenses. And therefore, just, to know that later in life, like, oh, you were saving to this plan for the last 6 years and you've accumulated X amount of money. Now, if you were a single person contributing, the contribution for this year is 4,300. If you are jointly, I think that amount is 8,550. Okay, that would be the max. So if you were doing that amount for 5 years or so, or even more, then that's a nice little chunk that you would have specifically set up for medical emergencies or just medical situations. And let's just say, your health has been great and nothing came up, and all of a sudden you're retiring and you have a HSA of maybe it's $50,000. I'm just picking a number, and you hadn't used it. Well, you still can take money out of it, but then you wouldn't get that tax advantage. So you could use it for other things. But the nice thing is God forbid there was a medical expense, then you have it there readily available. So, this was implemented in 2004 by, I think it was like the Medicare Prescription Act of 2004. They implemented this because they realized that medical expenses were getting so out of hand that what's a way that a person through, working and payroll could contribute and open up a plan that would offset some of these expenses. And the nice thing about this is that it's portable. You can move this to another HSA plan. So if you were leaving one job to go to another job, it is portable. And as we mentioned a moment ago, it is investable. So Nick,
I want to just add, we've got a good question here about, do you recommend maxing out the HSA account every year? And also, when it becomes eligible to invest, do you recommend doing that? The HSA, you kind of fall into, I would say the majority of folks that use the HSA, just being realistic, you get that tax-free treatment on the front end, you get it on the back end as well. And we all have no shortage of medical expenses, right? So it is easy to end up saying, hey, it's still a great benefit to use it as I have those medical expenses, I withdraw from it, it's tax-free, and that's still a win. But if you are in a position where you're actually able to treat this more like a retirement vehicle, that is something that, so if you're keeping, let's say, you come up with that comfortable number of what you need to keep in cash. A lot of times what I recommend is keeping the out-of-pocket maximum in cash to really have me covered for a given year. The rest of it, you can invest according to kind of what your goal for the funds is. Oftentimes that's going to be retirement. You're basically treating it as a retirement account because you'll be able to withdraw from that account later on in retirement, no shortage of medical expenses. And there's also a fun little exception where age 65 and beyond, you're allowed to withdraw from an HSA for any kind of expense without penalty. Now you don't get the same special tax treatment, but you're avoiding the penalty. So what I normally see is saving that so it's something that you can grow to cover your future medical expenses and get that tax-free treatment.
Yeah, that's a good point, because definitely by having it, you are preserving that retirement savings and just keeping this as an added source for those expenses. So perfect. So now, Nick, we are going to talk about our last important topic, which is tax loss harvesting. So take it away.
Great. So I know we've gone, I tend to do this. I like to ramble. I like to talk. So I'll try and concise here, but tax loss harvesting. Susan, if you go ahead and go to the next slide, really what we're talking about here is when you invest in, we're not talking about an IRA, we're not talking about a 401k, we're talking about like a general brokerage account where you invest $100,000, it grows to $150,000, you sell all of it. As long as you've held that security for over a year, you only have to pay taxes on the $50,000 growth, and it's going to be based on long-term capital gains rates, which are lower than your general. It's taxed at a more favorable rate than income levels. So the idea here is that you also, if your securities, if and when they go down, even if it's just temporarily, if you sell a security that's at a loss, you can realize a capital loss. Capital losses can be used to offset either current capital gains that you have or future capital gains. So, if I have a client that we've sold some well-performing securities, they've got a $15,000 capital gain. They've got this stock they've been holding for a long time. It's sitting at a loss of $10,000. If I sell all of those securities, I end up with a loss of $10,000, a gain of $15,000. They net again against each other. I only have to pay capital gains tax on the $5,000 net surplus. Now, let's say you took a much bigger loss and you do not have gains to offset it. You could actually use capital losses are things that you can actually defer into the future in perpetuity. So you can basically hold it. If you've got a $20,000 capital loss, you can carry it forward year after year until you have a capital loss to offset it. Now, you're also allowed to use $3,000 of that loss each year against your own income. So what we're talking about here is like, okay, well, Nick, how do I apply that strategy? Something that you can do in the investing, and this is something that you can do yourself or you can work with a professional. You can actually look at, hey, the market's it's had a tough start to the year, right? You may have a position that's sitting at a capital loss. That is something where you could actually sell that security and realize the capital loss and then reinvest it in another security. You've realized the capital loss, but you're still invested. Now, the idea behind this is, hey, let me go ahead and grab that loss now. I can leverage it now if I have future gains, or I can leverage it later because I can carry it forward as long as I want. And Susan, let's go to the next slide.
Perfect.
So where this, I think as far as how you're going to apply this, well, you need to either yourself or working with a financial professional to have those regular reviews to look at, okay, identifying underperforming assets suitable for tax loss harvesting. Once you identify those losing investments, you can come up with a strategy of, okay, does it make sense for us to sell this? And if we do sell it, what are we using that loss to net against? Or also, what are we going to use with those funds? Are we going to take those funds and reinvest them so that we're still in the market as part of our long-term investment strategy, but we're still in the market, but we've still, realize that loss that we can leverage either now or in the future. And then the next slide, Susan, if you could. Now, here's the rub with tax loss harvesting. You need to understand what wash sale rules are. The IRS knows this is something that's being done, and they want to be mindful that people are not necessarily just churning their accounts to realize these, just selling a security, buying right back into the same security just for the sake of taking advantage of realizing that loss. So they came up with wash sale rules. And basically what this says is that if you buy into, let's say you sell a security, you have a 30-day window on either end of when you actually purchase the security, sell the security. So you sell a stock, you realize a loss. For you to buy back into that same security, you have to wait 31 days. If you invest back into it within those 30 days, it's called a wash sale, and your broker dealer will disallow the loss. So you didn't actually realize the loss. You did all that work for nothing. The way that you get around this is you invest in something that is not considered to be a substantially identical investment. So, if you're invested in a large cap growth fund and you sell out of that large cap growth mutual fund and you buy into a different type of large cap stock fund, typically with funds, especially actively managed funds where you're looking at a different manager, different portfolio managers, those funds aren't going to be considered substantially identical. Now, if you're selling out of one investment and buying back into the same one, it's going to be pretty easy for the IRS to say, okay, that was, you invested into the same thing. The most common scenario where you run into trouble with this is with index products. If you invest in one S&P 500 index, you sell it, and then you buy back into another S&P 500 index, depending on the index, there's a possibility that they're going to deem that as substantially identical. Before you do this, you need to do your homework on basically figuring out, okay, what can I put this into that is not going to be detrimental to my investment strategy, but also not going to have a disallowed loss. Okay. So that's what you want to be mindful of. And if you run into any trouble there, just again, reach out to us. We're happy to talk through that with you.
Yeah. And Nick, you said something interesting on the former slide when we're talking about the loss harvesting, which was regular portfolio review. And again, part of that wellness, part of that maintenance, we're going to the dentist once, twice a year. We're doing our, physicals. Why not implement the same strategy with our financial situations, just so that we're not waiting to the last minute? And really important. So here we go. Let's conclude, and then we're going to do another poll question, and then we're going to answer some questions that we've had coming in. Okay.
All right, great. So we've reviewed tax efficient strategies, right? So this is something where ultimately what we're trying to figure out is what can we do now while we're working to help position ourselves in a better way in retirement to have a more tax efficient income stream, and also, hey, some things to think about as far as managing your portfolio, Roth conversions. Ultimately, how do you think about it from year to year? It's a changing landscape. Tax brackets are always going to be changing, right? We've got a moving target. When I think about, RMDs here, when I'm thinking about tax distribution planning for my clients in retirement, we're having a conversation every year to say, okay, you've got this amount of money coming in predictable taxable income. We're estimating what your required minimum distributions are going to be down the line. We're looking at your current assets. What type of taxable buckets are they in? What do we do from year to year now to not make any donations to the IRS if we can help it? We want to be efficient, but also we want to avoid having spikes in our taxable income, and things like being mindful of your RMD, how it works, Roth conversions, HSAs. Those kind of tax advantage vehicles are certainly going to help you be more dynamic in your strategy once you get there.
Yeah, so great. I mean, a lot of good information, so much to chew on. Again, don't get overwhelmed, everyone. It's like little bits and pieces, because this is intense. I mean, this could go on for several hours, Nick, right? I mean, with all the information we provided. So we just touched on some real common things that are, of interest, but maybe you haven't delved into. But again, maybe you have parents or family members that are dealing with this. So again, we're always here to be available to reach out. But Nick, there's some questions on here. I wanted to go.
I see a couple. Yeah.
There was something about the 401k. Someone said, I have a 401k. Are the tax implications for the 403b and 401k and IRA different? And we did kind of touch on this in the beginning. It's the nice thing is that they're all, reduce right. Your taxable income when we're looking at retirement accounts, 401k, 403b. And if you have a 457, not a deferred comp, but a regular retirement account, pre-tax benefit, saving for retirement, and then they withhold that 20%. And like you said, Nick, on the IRA, it was 10% or whatever the person would like to withdraw.
Well, right. With IRAs, it's usually going to be voluntary withholding. And they're going to say, hey, if you want to withhold 10% or more, that's fine. Thinking about some other differences, like I know we didn't talk about a 457, but a 457 typically doesn't have an early distribution penalty, so it's not subject to that 59.5 rule. That's more of a niche plan that's probably not going to be applicable to most of the people on this call. Another difference that I think of is, qualified charitable distributions. So one way, as far as getting money out of pre-tax accounts without paying income tax, you're allowed to do what's called a qualified charitable distribution once you are 70 and a half or older. And you're allowed to make distributions from your traditional IRA of up to $108,000 a year. As long as it's made payable to a qualified charity, it's not taxable. Now, this isn't a reason to be charitably inclined, but for those that are charitably inclined, it becomes a fantastic strategy to say, hey, I need to take out this required minimum distribution. Well, they're making me take it out. If you're doing any kind of charitable giving throughout that year, let's use a portion of that RMD as a charitable distribution so that you're not paying taxes on that. You can't do that in a 401k. You can do it in an IRA. So the differences between those tend to be not necessarily just on how the money is taxed when it comes out. It has to do with little differences like that. All right, I've got two more that I want to touch on here. Okay. Sarah asked, is tax loss harvesting similar to when a financial advisor says they are rebalancing your portfolio? It is very possible that if you have a financial advisor that's rebalancing your portfolio, they should be, with a taxable account, they should be thinking about tax loss harvesting opportunities. Now, rebalancing could also just be, hey, the stock market, end of 2024, stock market was performing very well. I'm selling from my stocks. I'm buying bonds to move back to whatever your target asset mix is. So tax loss harvesting is part of rebalancing. It absolutely is. And then,
go ahead.
Yeah, go ahead.
I was just going to say, Christopher asked that, I'm 65 and I'm thinking of retiring in 2 years. I have money in a 401k. Should I convert it all into a Roth and take the hit on the taxes for the entire amount? And I would say that is a good question to email us to meet with perhaps Nick about this, because too broad just to say a yes or a no. There's so many other factors. What are your goals for retirement? What do you have saved? House paid off, car paid, all sorts of, things.
How much are we talking about?
Yeah.
How much are we talking about? So, no, I agree. Roth conversions are something that it hurts me not to get into more depth in this setting of Roth conversions, but I know I could probably do an hour on just that because, when that's one of my favorite things to talk about in one-on-one settings because it makes for a really interesting conversation. Mm-hmm. But yeah, reach out to us, set up a meeting, and we can talk about whether or not that makes the most sense for you and how you would employ that. Also, just want to, shout out Clay. Clay, I love the different tips and suggestions you've got in here. I hope that people have been reading them. Your point about trying to leave the money in the HSA and cover your medical expenses out of pocket is great. If you can, we know that's not always realistic for you, for you to be able to do that. But if you are able to do that, it really does make an HSA into a fantastic, growth opportunity.
Another thing, Anna says, our employer doesn't offer an HSA. Can we open one outside? First off, I would say you have to be associated with the high deductible plan. If you are not, you will not be able to open it. So if that is the case, again, Nick, do you work with a provider? I mean, there's many out there, but is there somebody special? I know Fidelity has them and Vanguard, but I don't know if you have somebody that you work with specifically.
I don't have a particular provider that I say, hey, go to. I have providers that I like for a lot of different things, but for an HSA, not necessarily. And I'll tell you, honestly, the reason why that is because if an employer is offering a high deductible healthcare plan, they are almost always offering an HSA in conjunction with that.
True. Good point. Let's take a poll question before we wrap this up. We're a little bit over, but we don't mind answering these questions. So let's do, maybe one more poll question and then see what you think, Nick, as far as a couple more questions before we wrap up. Okay, everybody. This is like a little fun question. Spring is a perfect time for a fresh start. If you could give one area of your finances a thorough spring cleaning, what would it be? Would it be budgeting, a time to dust off those expenses, savings, a need to grow my emergency fund, investing, ready to plant some wealth, or debt, decluttering those balances? So let's hear what everyone has to say. And
I'll tell you right now, it's budgeting for me. I can always use more attention. That's the definition of spring cleaning for me.
yeah, I like the one of investing, ready to plant some seeds, specifically with the market going up and down like this, repositioning maybe. Okay. So, what should we take for maybe two more questions? Anything?
Yeah, I had one here. Joe had asked, wouldn't it be better to pay the tax later since your retirement years you would need less money and pay at a lower rate versus when you're working? So this is regarding the conversation around do I make contributions to a traditional or a Roth 401k, I believe. So you're exactly right, Joe. In that, one of the examples we gave was someone that is closer to retirement. They can look and see, hey, I'm in a higher tax bracket now. I'm going to be in a lower tax bracket later. I would rather not pay the taxes now. I'd rather make pre-tax contributions, deductible contributions now. But someone earlier on in their career, I talked to plenty of people in their 20s and 30s, and they're in the 12% tax bracket. They're in one of those lower tax brackets. And we're looking and saying, okay, well, I don't think I can't say that you're going to be in a lower tax bracket in retirement based on where your income's at right now. And you have all those years, the more time you have for those contributions to grow tax-free and compound, that's kind of a perfect picture case for someone that Roth likely makes more sense. And of course, there's exceptions to this, but do I make Roth contributions? Do I make traditional contributions? Is probably the number one question that I get asked in educational one-on-ones.
Okay. Anything else you see there, Nick, before we wrap
up? Clay is just ribbing me here because he knows that I have two children. Children are expensive, Nick. Yeah, no, that's I'm getting I've got two kids, one age 1, one age 3. I'm starting to get that lesson, Clay. So thank you for anyone that did not know. Good information to have.
All right. Okay, so let's wrap it up. And I want to thank everyone so much for taking the time out, for coming along with us today. You had great questions. Thanks for answering the poll, and we just had a lot of fun today. And Nick, what do you think?
If you can't tell, we talk about, what I like to say is that in the one-on-one meetings that Susan and I do, we talk about just about everything with a dollar sign next to it. But when it comes to tax efficiency in retirement, I love talking about it. It really works on a one-on-one basis. It's going to vary so much from person to person. There's a lot you can do to basically figure out, how do I keep as much of this as I can? How can I be as efficient as possible as I start to distribute my money and live my ideal retirement? So no, I love covering it. I think that I really appreciate everyone's questions. That was great. And thank you for joining. I hope that we have some one-on-one conversations with y'all following this. You're going to get more information about how to set up time. That banner has been giving out an email as well. So thank you for joining.
Okay. Thanks, everyone. Have a wonderful night. Bye-bye.